Welcome to AGENT21. We've got Dean and Rick going to help share with us our association tips and tricks. Dean, Rick, go ahead, introduce yourself. Let us know where you're located, and then we'll just have you jump in. I did allow everybody to have the mics in case you have any questions, and I'll be right here. So without further ado, here we go.
All right. Well, I put together a slideshow, so that brings us to our next slide, our presenters. Hopefully you can see this, but I'm Dean Forster. I'm the Minnetonka office manager. I started investing in real estate in 2000. It's kind of one of my niches. I work with developers, builders, home flippers, and I'm a hard money lender, and I'm currently serving on the board of my Minnetonka condo. That brings us to Rick.
And Dean wrote that one-liner there. I've been licensed longer than before the invention of computers. That's probably true. I'm a two-time former board member of two different townhouse communities. I served 6 years at one and 6 years on the other.
So we talked about doing this. I thought I understood a good amount about associations, and I feel like having done this job for now coming into year 17, I feel like I usually know more than the other agent on the other side, but when I joined the board, I realized how much I really don't know. And even more frighteningly, I knew more than anyone else on the board. So I thought, you know, we should probably, I've over the last close to a year now, I've really had to dive in and learn via the school of hard knocks. But by the whole point of this is we are not experts. We are not attorneys. So if anybody out there has more knowledge on a subject, chime in, but we'll share with you what we've learned. All right, so MCIOA, what is it? Why does it matter? It's the Minnesota Common Interest Ownership Act, and it took effect in Minnesota on June 1st, 1994. So when we do a transaction as realtors, we often include the MCIOA document. What is it called exactly? Go to the MLS,
community,
the form.
Townhouse and condo common interest community addendum.
Addendum, yeah. And what's important to that is it provides a 10-day revision period. It gives your buyers or sellers, I guess if you're on the sell side, yeah, it gives the buyers 10 days to review all of the documents. All of those documents include the resale disclosure certificate, which we're going to show an example of that. But it also is the balance sheet, the income statement. It's all of those things, and we'll get into that later. But this act came out in 1994. It requires the associations to reserve adequate funds for common areas, secure insurance for common areas, undergo an annual financial review by a certified third-party accountant, and then provide that resale disclosure so that buyers can make an informed decision. Now, there are exemptions. If you were formed, and in my case, our condo association was formed in 1982 and the two buildings were built. We have 130 units between two buildings, but we don't have to comply with MCIOA because we were formed before June 1st of 1994. So that being said, if you're doing a transaction, like when I went to purchase this, if I didn't put that addendum in there, which said that we have 10 days to review this, I wouldn't get the 10 days, right?
Yeah, because both parties have to agree to it.
Yeah, both parties have to sign off and agree to it unless there's a Minnesota statute that requires it. Well, the Minnesota statute requires it if you meet all these criteria. This came up recently, single family associations with no obligations to maintain the building. So the window, siding, roof are all the homeowner's responsibility. We see that a lot in single family homes where they might have an association to control the architectural covenants and maybe the monuments as you drive in. Possibly there's a common park area that they keep up. Those are exemptions from MCIOA. Non-residential associations like the office condo we're sitting in right now in Minnetonka wouldn't have to comply. And then there's a number, if the association's small enough, they don't have to comply. And I ran into that in Victoria. We had a smaller association. I forget what that number is, but you can Google it. So those are exemptions again, but so you would have to include that form if you want your buyers to have the ability to review the financials.
And can I just add this?
Yeah.
Both the associations that I lived in started before that date of 1994, and both of our associations at the time that this came out decided to opt in to it. And it, it's kind of 50-50. I mean, it is kind of a good governing board. However, it is a little restrictive, especially for small associations. The first association I was in was 16 units, and then the one I'm in now is 27. So there's a lot more restrictions that you have to follow, which is a little costlier.
Can you think of a restriction? I don't want to put you on the spot.
This is something we'll probably bring up, but every year, is it 3 to 5 or 4 years? They say you're supposed to have an audit.
Yeah.
Or not a review.
Are you talking about a reserve?
Yeah, reserve audit. Okay. We do that, but technically, I don't think you have to. It's suggested, unless it may be under.
I'll get into that because that's something that came up. We've never had a reserve study, and I was concerned about it. So I'll touch on that. So there's the two. So I've had to kind of learn the hard way because there was no one really to guide me, and our management company was not good. They wouldn't call me back. I wasn't on the board at first. I was just on the budget committee, and the existing board was just not really very good. Sorry, but anyway, so there's obviously your governing documents have rules. It's important to look at your governing documents of your association. They set out the ground rules, but like anything, there's statutes. So state statutes supersede the rules of the governing documents. For example, I could put in the I always use this as a really crude, crass example, but I could put in the governing docs that if you fail to pay your association dues, we can sentence you to death. However, that would violate Minnesota and federal statutes of murder. So
and you'd lose a lot of
yeah. So state and federal law supersedes anything you put in those government in the governing documents. So on the state statutes, so statutes 515A apply to most condos if they're formed after June 1st, 1994. Statutes 515B come into play. Little confusing, there's legalese in there, but the good news is those statutes aren't a whole lot different. So statute 515B, though, to Rick's point, does have a few more restrictions. I'm going to kind of keep it at that unless someone really wants to take a deeper dive on that. But yeah, so I was being told things like, well, we don't have to give you that info. Oh, let me back up. So they said, well, we don't have to share that information with you unless you're on the board. And I thought, wait a minute, I have ownership in this. I want to see these contracts. I want to see these documents. So I dove in, and it says plain as day, right in those statutes, any homeowner has the right to request these financials. So that was a bunch of bull crap. And we had to really challenge the management company on that. And they did backpedal when we got the attorney involved. So yeah, that was real. Okay. Rick talked about reserve. Well, what are, when you read through the statutes, what are the obligations of the board? Ironically, a lot of people blame the management company, but the management company isn't responsible for maintaining the association other than what they agree to in their contract. It's the board that ultimately decides what needs to be done, and the board is elected. It's usually about 5 members. And they have to save for future repairs, comply with the governing docs, and protect the value of the buildings in the association. And that's usually also stated in the governing documents. So that's what they are required to do. You talked about a reserve study, and what a reserve study does is it looks at the state of the building, the upcoming expenses. And I was told by several other management companies that it is required by law to do a reserve study. That's not true. Right. They are, however, required to save for future repairs, which a reserve study would help you accomplish, but you do not have to do a reserve study.
A reserve study simply just projects out into the future how much things will cost. For instance, our association in the last 5 years did all new roofs and driveways. So that depleted a lot of our reserves, but yet the reserve study shows that with the fees coming in and the reserves that we have left, we can reach the next goal of new siding. So, you know, that it helps. It's kind of more of a guidance than a mandated thing, but it does help the residents at least kind of plan ahead in case they have to have a, you know, a special assessment for certain things.
Mm-hmm.
Can I just jump in here for 1 second?
Yeah.
Yeah, this bit about the reserves is really probably one of the most important things when you're doing your due diligence about a condo or townhouse association that you can spend time and attention on. The danger is that the developer, when he creates the condominium or townhouse community, underestimates either the useful life of the elements that will need to be replaced or the cost of replacing the items that need to be replaced down the road. And the reason the developers do that is to reduce the amount, the annual amount that'll go towards the reserves, so that they can keep their initial condo fee low to attract potential buyers.
Mm-hmm.
And when the association turns over management from the developer to the homeowners association, if they don't go back and really be careful about that and take a look and see, have we stacked up enough for adequate reserves, going forward, they'll just get deeper and deeper in the hole. So it's particularly important, particularly if you're going into an association that's just recently taken over management from the developer, to make sure that those reserve numbers and reserve contributions are going to be adequate down the road. That's the situation in the condo we're in, and it's really taken a toll on the communities that goes forward. Mostly older people here, so okay, let's keep the fee low. You know, that's what the developer set up. So then all of a sudden, bang, $85,000 split 19 ways is not a lot of fun.
Yeah, and that's really the only question. So my job has been to come in and kind of look at these. We haven't changed vendors in 20 years for a lot of these, and just already I've gone through about half the vendors. Our annual budget's $880,000, and I've saved $40,000 so far in just the last 2-3 months by just, you know, yesterday I talked to the cable company, and we're paying for there's a business side, there's a residential side. We have 2 party rooms. We're being charged twice for cable and internet. We don't even have internet in either of those rooms. We have cable, and we're paying twice. And then the internet that we are being charged for, actually we do have internet for our security. It's like an old contract that's triple what it should be for half the speed of their lowest speed available today. So these management companies, and more importantly, the board, need to look through these contracts, look through the budget every year, call the vendors and get quotes and things. So yeah, I've already saved 40 grand, and I know there's easily another 40 I can save. So when you look at management companies though, they all have horror, because we're shopping around for other management companies. Ours just recently sold to a company out of Florida. So, you know, so I'm shopping for 2 reasons. One, I want to see if we're paying a fair rate, and we're paying higher than anybody else has quoted me. So, but it's not exorbitant. So number one, probably not paying a fair rate, but 2, just to kind of see what's out there. Our software is antiquated. The way we handle things is bad. But when you go on Google and look at reviews, they almost all have less than 2 stars. And when you read the comments, there's things like, they don't shovel my driveway in time. It's icy. They never put down salt. By the way, these contracts for snow removal usually state that they only come out if it's 1.5 inches or 2 inches. They can come out for less than 2 inches, but you're going to spend a fortune. So people want to have their cake and eat it too. It doesn't work that way. So the board is the one making these decisions. It's very frustrating to read the reviews and see almost 90% of the reviews are really complaints against the board.
Yeah.
And really poor communication by the board, and it has really nothing to do with the management company, which is very frustrating. And then it's always, they're spending too much money. They're spending too much money. Well, the board is the one approving these expenses in theory. And it's their job to watch the management company and make sure that they're not overspending. So really all these complaints are against their board. Yeah, rhetorical question there, but how many of these are actually due to the management company? All right.
Dean and Rick, there's Lori's got her hand raised if we want to take that question quick.
Oh, she does.
Oh yeah, here's Lori.
Hi, Lori.
Good morning. Actually, the MCIOA does require that associations reassess their reserves every 3 years. That is a requirement.
Yes, but you don't have to do a reserve study to do that.
Okay.
So
but
here's
again,
what a reserve study. A reserve study is usually done by a third-party company that comes in, and we did talk to an attorney, Lori, and asked that question. He said it can be done in-house. It does not have to be an independent third party, which is what a reserve study is. And that's usually done by an engineer, and they'll come in and evaluate things. They'll do a financial forecast, and then they usually give a letter grade. That's something my brother's association ran into, is they want to redo their siding, and they also wanted to redo their reserve study, and they got a letter grade of F, and they didn't want to publish that reserves.
I just wanted to make sure that people understood that they do have to review it every year, every 3 years, but it doesn't have to be extensive. And when you were talking, you made it sound like it didn't need to be done every 3 years. So I just wanted to clarify that.
Yeah, I understand what you mean, Lori, because like ours does it every 3 years.
I've never heard the 3 years in anything I've read. We do it constantly. So it's an ongoing thing. It's done monthly, really. But I don't know where the 3 years comes from.
But the association I was in before, we were self-directed, no management company. And we had a lawyer. I can't remember exactly the situation, but we didn't hire somebody specifically for a reserve study, even though it was kind of a third-party evaluation. Our association currently does it just because it helps us justify raising fees and that type of thing, to meet certain costs. But it is in there that you do have to, what were the words that you used, Lori, exactly?
It requires a reassessment of the adequacy of the reserves at least every 3 years.
Right.
Okay.
Right.
That's in the, are you reading from the statute?
Yep.
Okay.
Thank you.
So that's straight from the statute. Yeah, we do it way more often than that. So here's what we do. This is our reserve schedule. This is just a snippet of it because I wanted to show it for the slide. So what they're doing is they're forecasting. I can't remember. Does it say how many years by chance? If you don't know, that's fine. But I think 30 years, give or take. We schedule out. We look at the major components. And then the important part of this is at the bottom there, you have your starting reserves, you have your total costs, and then your addition to reserves. And then that leaves you with a balance at the end of the year. And the reason my brother's reserve study gave him an F rating is because that balance went negative. So our goal is to make sure that that bottom line never goes negative. And to Jeff's point, this is all fine and dandy, but how good is this reserve schedule? And you can hire the best engineer in the world. I'm talking to the boiler guy, and I've spent days with 5 different boiler companies, and one of them points out the 5th guy in there. Oh, we have baseboard heat, hot water heaters. The recirculating pumps are 15,000 a piece. So we got 2 in each building. Well, we don't have that on here. I mean, we try to overestimate things, but there's no way you could possibly, even just in the mechanical room, there's stuff everywhere. So you can't possibly A, have a crystal ball, know when it's going to break down.
Yeah.
They're working fine, and B, like go through every single component. So there's a bit of what do you call that? Sorcery involved there. To Jeff's point, you do the best you can, and you hopefully pad this with an overage and things like that. And we've got extra money in decks and boilers that we really don't need, and hopefully it all works out in the end. But it's not an exact science. You want to add anything to that?
Well, just about when he was
Yeah.
giving the example of the boiler, I know we used to have a painting schedule, and the reserve study person that did ours said, I don't know why you're painting every building like every 5 years. There's some of these ones that face north that they look like brand new siding. They haven't had sun damage or anything like that. Why don't you have a committee put together to walk around and do the painting that's needed each year? And that saved a tremendous amount of money.
Yeah.
But like you know, in your case, you need 15 new boilers. Well, you only need 7.
Yeah.
Ones, you know.
And that happened to us. They said we needed 16. I had some professionals out. They said, no, 8 of these are 10 years old. You only need 8. In fact, you're running, you know, we really only just need 2 this year. So we saved 170,000 off of that estimate.
Mhm.
Yeah. So there's 2 things going on here. This is not the budget. This is the reserve schedule. So this is for long-term repairs. We have a budget as well. So something we save money on is every year we power wash our underground heated garages. And that involves us having to snake the drains out because all the muddy water runs into the drain. Well, we just did it. We're doing it every single year. It barely snowed. They're not even dirty. So we just made the decision that we're going to skip it this year. And that saved us $9,000. Now that's $9,000 we can put towards something else. So that's kind of how this works. Let's see what else we got. This is the resale disclosure certificate. Most management companies have their own form that they'll send out, but this is the one I got off of the MLS and I just cropped it, but it's a 3-page form. And it goes through all the different financials. I had a transaction where the son was buying a house and his mom worked for a broker out in California, and she was super helpful in getting involved in the transaction. And what happened is we were about to close. The week of closing, son gets a job on the other end of town. We were way on the east side, what's that city out by Woodbury? Can't think of it.
Oak Park Heights?
No, anyway, Oakdale, yes.
Oakdale.
Yeah, he gets a job in Minnetonka. So mom points out the fact that the seller never gave us a balance sheet. Well, they gave us the resale disclosure. They gave us the governing docs. They gave us everything but the balance sheet. So technically the 10 days hasn't started on that window. And therefore they were able to get out and get all of their earnest money back.
Wow.
Day before closing. It was the day before closing. Yeah. So I can count on one hand the number of times I think I've had this delivered properly. I almost never get all of the documents,
And
which is embarrassing.
A lot of agents do skip this too. And Lori, I know we communicated, I didn't have the documents yet, so I didn't get the receipt done, but I think now I've sent them into pipeline. But this is very important to go over because you have to make sure they get all the documents that are required, either on this form or the one that the management company sends out. Because it's, you know, like if they miss the balance sheet, I mean, some of those things are the most important. A lot of times people don't read the whole articles of incorporation because it's all legalese, but I suggest people read everything, but you got to make sure that they have everything. And I know Century 21 does require that we have this signed and turned in.
Yeah, they almost never, like I've had to fight people about the receipt.
Yeah.
Oh no, I've never done that. They argue with you. I've sold lots of townhomes. I've never had to do this. Well, just because you did it wrong before doesn't mean you shouldn't do it right this time.
Well, that's so true because, and
I'm sure Lori sees this all constantly.
Oh, I'm sure you do. Yeah.
So one of the things I see most often when agents are selling common interest community properties is they do not use that receipt. And that receipt is so important because it starts that timeline of the 10-day right of rescission. The other thing that I see very common is they waive all of the 10 days. And you cannot waive all 10 days.
It's 4,
you
right?
have to give them at least 3.
3,
So
okay.
it's extremely important that if you are actually helping a buyer sell their common interest community property and trying to purchase another property that is subject to this CIC closing, you have a tough time with that because you have to give that 10-day right, and it isn't, the seller cannot force the reduction of those 10 days. So you have to be really, really careful with that.
And I did sell in a townhome community, and I was on the board. I guess I've been on 2 boards. I forgot. I was on the board for a builder, and he would always get that 10 days brought down. He'd give them an incentive to do it.
Well, the clients I'm working with now just contacted me and said, we're done reviewing them. We're okay.
Yeah.
In other words, so you can.
There's a form for that in the MLS too, to shorten the.
And I would use that form.
Yeah.
Otherwise, if you don't have it, that can cause you problems as well.
Yeah.
And that's in the MLS.
It's in the MLS, and I do think it states right on there 3 days, like Lori talked about. You have to do at least 3 days.
Well, they did 7 days,
Yeah.
So they did it. They just said that we're done reviewing them. So
yeah,
whatever. So there is a form for that to.
Yep.
Okay. I'll have to fill that out.
So yeah, you can't just
it's a waiver.
have an email.
It's a waiver of CIC, I believe.
Yep.
Okay, very good. Yeah, that resale disclosure certificate, every management company has kind of a different thing, but
it should have all these. It's very similar though, because it has to follow the statute.
Yeah.
Yeah.
But that's the most important because it shows you things that are in the works that maybe the agent doesn't know or the board hasn't told, things that are going on right now that the buyer should know.
And that's actually where, when the guy was telling me I don't have to disclose any of this information, you're not on the board, that's where I got the statute from. I pulled up, it was either one of these MLS documents. It says right in there 515B, and that's where I started looking. And Lori, hats off to you for being better at reading this stuff. But with all the legalese, it's a good cure for insomnia. Can't say it's my favorite thing to do, but I had some fire under me saying I'm not being treated fairly. So I digress. All right, so that's what resale disclosure is.
One thing there is if you're representing a buyer and there's some kind of document that you want to take a look at before you sign off on your right of review, you should be in contact with the listing agent and put it on the listing agent to round up that document for you. For example, taking a look at minutes or notes from the or transcripts from the board of directors meeting is awfully a good way to find out the things that are on the horizon but don't quite come up in the resale certificate, things that you might want to know about before you bought.
Yeah.
Like sooner or later we're going to have to do something with the 3 ash trees on the property because they're not looking that good. That sort of thing. But you can back through that request by saying, we'd like any information that you can provide from the minutes or transcripts of the board of directors meetings concerning the ash trees, things like that.
Yeah, minutes are great because they don't give you that unless you request them. And minutes are the notes taken at the meetings, and people come to meetings to complain, don't they?
Mm-hmm.
So what's that FX show about vampires? It's a comedy, and the guy said, I love city meet. He's an energy vampire, so he's a day walker, and he just sucks energy from other people. He loves town hall meetings. They're just his favorite thing to do. It reminds me of board meetings. So yeah, read those minutes, and people get all their gripes out at those board meetings. All right, so this next slide, analyzing reserves. I was just going to open this up to everyone else. So, okay, we're selling a condo, townhome, common interest community, and they send us the financials. We forward them to the buyers, and we say, this is, what do we tell people? What do we look for? How do we analyze if this is a good, you're basically going into business with your neighbors. How do we analyze this business to see that the business is operating properly? So I'm going to open it up. I kind of have my way, and I admittedly for years just going off of School of Hard Knocks.
I usually tell people right off the bat that I'm not an accountant or a lawyer, so they should check with their accountant if they have any questions or somebody that's knowledgeable. But if they have specific questions, I don't try to dig too deep because I don't want to be held liable for anything.
Well, there's that part of it too, yeah.
But you know, because some things are kind of relative too. You know, like our complex is small; it's 27 units.
Mm-hmm.
And so our fees seem to be a little higher than some. So I explained that to them. And I said, you know, this place in Plymouth has 150 units and theirs are 350. Ours are 410. We have 27 units. So proportionately, you're probably giving less than they are, you know?
Yeah, so that's something I've done in the past is look at ask how many units there are, and I'd be amazed how hard it is to get an answer to that question. Well, I don't know. Well, it's kind of important, like how big is the association we're getting into? It's a fair question. So if they've got 300,000 in reserves, but they've got 600 units, that's $500 per unit. I hope I did that right. It's not that much, but if they've got 300,000 in reserves and there's only 30 units, I mean, it's a ton of money.
Yeah.
10 grand per unit? Did I do that math right? So the other thing to take into account is, so I'm doing in a common interest. So actually, I'm not sure if it qualifies, but it is a common interest community, but they only maintain the common elements. They basically take, it's what they call villas. So detached single family townhomes. So they don't have a ton in reserves, but they also aren't responsible for doing the roofs, the windows, the decks, the components of the house. So I think it kind of makes sense that because they don't have to maintain the houses, they're not going to have as much in reserves. In the case of ours, we just got a brand new roof 2 years ago. Our siding is brick and it's in good shape. A lot of our decks have been redone. So a lot of when you look at that reserve study, that's where my brothers went to enough. They're spending $1.5 million on their siding, fascia, and gutters.
Yeah.
And it needs to be done because it's vinyl and bats and animals are getting in and water intrusion. And they've been kind of fixing them as they come. And they're realizing every year we spend more and more fixing the siding. And it's to the point where it's just going to be smarter to put new siding on now. We're stepping over dollars to pick up nickels.
Dean, I think it's also important to make sure that buyers know what insurance covers what.
Yeah.
So for example, if it's, units that have common walls, and if one unit burns and comes into the other unit, whose insurance covers what? Stuff like that. And for example, they might replace windows. Windows might be covered by the association, but the inside part of your windows might not be. So, certain things like that need to be figured out as well.
Lori, thank you for bringing that up. I don't know I think there's a slide on this too, but recently in the last couple of years, some of them should we wait till we get to that slide?
Either way.
Some of the major companies, American Family, State Farm, Farmers, have decided not to insure townhome associations or condo associations anymore. We ran into that, and then they were going to have their brokerages look for insurance, and we couldn't get it, so we had to go self. But when we did those policies, we had to, what you said, Lori, had to make sure that there was coverage in case it encroached another unit. Because a master policy does, but when you don't have one anymore, your own personal insurance has to cover that. That's been one of the biggest issues in condos and townhomes selling, I think, in the last couple of years, is you have to know who's insuring the place and what you need for insurance. And it's costly. That's one of the main reasons why these fees are going up, because some insurance policies have doubled or tripled in the last 2 years.
One of the comments that Dean made he was saying that he was reluctant to provide any opinion to the buyer as to the adequacy of the reserves. And I think that's probably a correct position to take because that's a little bit of out of our areas of expertise. But one of the things I've found helpful in getting a feeling about that is is to get that reserve schedule to whoever is doing a home inspection for you, and to get his comments on, do we, are they being legitimate about the life expectancy of the elements that are really going to cost a lot. And if that's the case, then perhaps at that point, you may want to get an engineer or an architect in to take a look at the situation. But your home inspector, if they're a good home inspector, should be able to provide some bit of guidance to you as to what steps you might need to take to verify that everything is in good shape.
Yeah, and I would add that they don't usually give you the reserve schedule. You got to request.
Yeah, you got to ask for it.
Yeah, and so the reserve schedule, just to be clear, is a component of a reserve study.
Yeah, but yeah. They should have one.
Yeah, yeah. So that was frustrating because I met with Associa, they're a management company, and the guy was kind of young, and he was telling me, no, it is required by law that you have to have a reserve study. So I sent him the statute with specifically what it says. He never even replied. Or no, he did. He said, oh, thanks for the information. That was it. He never got a proposal or anything to us. I'm sorry. Some of these Associa is a big national company, and my experience has been with these big national companies in particular, what happens is they take what are good managers and they overwhelm them, and they work them like 60 hours a week, and they're good when they're new, and then they burn out and they quit. So in the case of my brothers, he travels a lot for work. He's on their board, and he'll schedule a meeting and they cancel last minute every time. And this last time they canceled the day before, and they said, we're sorry with the short notice. We would have given you more notice, but we were just notified today that this person's quitting, and they didn't give us 2 weeks. So that's kind of how that position works. So if you are shopping for a management company, you want to see like how many hours are your managers putting in, how many properties do they have, so, and I had a smaller company say we treat our employees well, but I keep losing them to companies that'll pay them 15 grand more a year, so these are people making 70 a year, give or take, and they'll come off from 85 and they're gone, but then they burn out. So that's kind of what I've learned the hard way. Let's see. Oh, the other way, my buddy's an accountant and he's on his board in Eden Prairie. And what they look at is they do reserve studies. They used to do them every year. Now they just do them every 3 years, probably because of that statute Lori talked about. But in their governing documents, they say the reserve should be at least 70% of the annual budget. So that's something a quick way you can kind of look at something, say, okay, their annual budget is, in our case, 880,000. We have 200,000 in reserves. I don't think it's enough. And fortunately, we just spent a whole bunch of money on our most expensive things, but we're trying to build it. But what's quick math on that? Less than 25% of our annual budget is held in reserves. So theirs is a smaller association. Their budget's much smaller, but they have a mandate that you have to have 70% in reserves. Did you guys do it that way, or?
I can't remember exactly. I know that 20% of our monthly income has to be put in reserves. But now that we're self-insured, we decided not to lower our association fee since it was already raised to cover that, and put that another 20% in to build our reserves. And that has to be a vote of the association.
Yeah, so that's something else I talked about was the statutes, the state law does not require that you put anything into reserves. However, Freddie and Fannie, and I got this from an underwriter that I emailed because I wanted to know, like, how much should we be putting into reserves? Freddie or Fannie wants to see a minimum of 10%. We put in just over 10%. That's in our budget, but as the management company pointed out, there's really no checks and balance to see if that money, we budget for it, but does it actually go to reserves?
I think Minnesota statute does not require a dollar amount, a certain, or even a percentage.
Yeah, that's what I said, but the Freddie and Fannie does. They want to see a minimum of 10%. So you're putting in 20%, you're good. Yeah, but then there's no follow-up to check to see if it actually goes in there, which,
And
yeah.
Leanne's got her hand raised.
Oh, hey, Leanne. Do I do something? Oh, unmute her?
She can unmute and come on out, Leanne.
All right, Leanne,
Hi.
unmute, please.
Hi, good
There she
morning.
is.
Sorry, this isn't a timely question. I'm circling back because I wasn't somewhere near my computer. But on the receipt, this is a question for Lori, I think. I want some clarification on receipt of the docs. On line 57 of the CIC addendum, it says receipt of the documents relating to the association by buyer's agent or licensee representing or assisting buyer shall constitute delivery of documents to buyer. So I've always used that as my day one.
Yeah, that's a good question. When does day one start? When you get that receipt or when you deliver them?
Why I know there's an emphasis on the receipt now to have it uploaded, but it never was an emphasis for me because of this language. That's why. I've been getting it signed now, but I'm one of those who never did because I've been using this as receipt. So that's the end of my question.
Well, even if you do get it signed, when does the date actually start? From when you sent it or when they sent back the receipt?
It's kind of the same thing as when is a final acceptance date? It's on delivery, correct?
Right, but this says delivery to the agent. That's what this language is. So that's
how the final acceptance date of a purchase agreement works as well. It's because you represent your client, you are basically them. Okay. So that's how delivery is looked at in our state.
Right, but if the buyer doesn't sign that receipt for 3 days because their agent doesn't send it to them, I don't start calculating the date when they sign it for that reason. I use this date when the agent says, got it to me, then I know that's when we start calculating because of this language. That's how I've always done it. Is that correct or incorrect?
Well, technically, if you are representing your client, you should get that to them as soon as possible.
Of course, I'm just saying as a listing agent, I guess. I'm looking at it as a listing agent. Have I satisfied delivery once the agent says I've received these association docs? That's when I start day one because of that language, not when they send me back that signed form, because that could take days sometimes.
And
this is like super common.
Yeah,
I feel like it's important for the calculation of days because of that scenario that Dean explained. So,
you know what? I'm going to call legal on that because I can't answer that question.
Okay. Yeah. If
it's the actual signature of when the buyers sign it, or if it is delivery to the agent. So that's a really good question.
Okay, thanks. I'll go back off. Thanks for addressing that.
Yep.
Can I just chime in there a second? I don't know, can people hear me? Yeah. On the receipt, I put the date that I know that they were delivered. I let my people know they were delivered. And then they because it was in the evening, they signed it and dated it the next day. But on the receipt, it says the date that they were received. Does that make sense?
Yeah, but the one more thing for Lori there, it actually says receipt by the buyer's agent. So, for example, I had this, when did the day start on a townhouse I recently sold, and I had sent them to her the same day as purchase agreement by email saying, here are the association docs, please confirm receipt. She emailed me back at 7:30 the next morning, said received. So technically, I think her receipt was that next day. So it's a little bit technical, but I do think it matters. So some clarification probably.
Oh, now you're muted, Lori.
Sorry. That's
okay.
I mean, that's why I'm going to call because technically if it was 3 days that they said, yeah, we got them. that's a big difference because that adds to those 10-day right of rescission. And that can make a huge difference for a seller or a buyer, depending on how you look at it. So,
yep. So
I'll find out the answer and I'll let everybody know.
Thank you.
Thank you.
All right. Hopefully this is valuable. This is the stuff I didn't know what I was doing when I was brand new in the business. I still kind of feel like I don't know what I'm doing. All right, so assessments, pros and cons. This is a slide I think is important. We look at assessments as bad, but it's a quick way to raise funds. What it allows you to do is get money for a project without having to up dues, because when you up dues, that affects the buyer's ability to qualify. So that was something the management company and the board and our complex disagreed on. And I was a big proponent of not having assessments. I think it's a red flag for underwriting. And I've had 2 deals get called into question when the underwriting, now they're supposed to do, you know, what underwriting's supposed to do and what they actually do are probably 2 different things. They're probably supposed to review every document, but when they see an assessment, they dive in deeper, and sometimes you want to avoid that. So the cons are, yeah, the tenants hate them. All of a sudden they got to come up with a big chunk of money. We talked about the financing. It affects their ability to qualify because it goes on the debt side of the equation. And then buyers will often ask the sellers to pay all those off versus if they had been projecting it out, using reserves and projecting it out over 20 years, the buyer would be more willing to basically accept it. I don't know. Anything else you want to add on reserves, or I think you kind of understand what reserves are, but maybe not.
Yeah, I think maybe I just want to say this in general. In counseling buyers or sellers even, or even people in an association at board meetings, you know, people say, well, we don't want the fees raised because it will make our places less saleable. But actually what's the turn of events that's happened since a lot of these associations have gotten older is now the turnoff is the lack of reserves more than the monthly fee.
Yeah.
When I first moved in 18 years ago to the complex I'm in now, I went to the first meeting and they raised the fees for the next year $5. Well, $5 times 27 times 12 months is like $1,600. And it's like, that doesn't even take out an ash tree.
Yeah.
You know, so to me, I said, why did we keep going like $5 and $5? Why don't we go like $20? So then when the time comes, we don't have to do like a raise of $50. You know, that's kind of,
and that's what got us into hot water is the guy never would raise the dues because he wanted to keep his management contract and keep everyone happy. But to Jeff's comment earlier that watch out for builders. Well, the builder I worked for had him artificially high. And the reason he had him artificially high is he used to run Canadian Homes, the top 5 builder in Minnesota, and got sued a whole bunch. So he was afraid of being sued. So he always kept it high. But yeah, but he would, so he would tell everyone dues go up. That's what they do. So there's this perception amongst our residents that, oh, dues don't go up. Well, there's such a thing as inflation. So we're just setting the expectation that expect 3% every year. And I'm guessing $5 is not 3%, but annual inflation is pretty close to 3%. So that's just what happens.
It was painful to catch up, but now that we're caught up, we've been able to pump into our reserves because we're an aging complex. You know, we were built from 80 to 82, and there's a lot of costs. And that's in maintaining a complex. That's
probably another way you could evaluate how well it's run is see what the increases have been over the last 5 to 10 years. Are they going up similar to inflation, or are they, you know, we just had to do a huge hike and it was directly because of insurance. Yeah.
Keep in mind with the tariff situation, the prognostication is that the cost of building materials is going to increase dramatically.
Well, I appreciate the comment, Jeff. I am not bringing up tariffs at our board meeting, but thank you.
That's good.
But Helen with her MAGA hat, and I'm not kidding, we have a resident, that's not her name, but she did come wearing a MAGA hat at the last meeting. Tell them the story about the people that were helping you when you were on the board, and you on your way out gave the 2 gentlemen the advice about.
Oh, these 2 guys that live in our complex. They're I think one's an original owner, but they always catch you when you're at the mailbox, or they always catch you coming out of board meetings or whatever, and they just want to bend your ear. And I was kind of frustrated because a couple projects we did specifically for them at their request that wasn't part of a regular schedule. And, you know, we saw the need for that, but they were just complaining to me one day, just bullet points. And I finally stopped them and I said, okay, none of you have ever been on the board. And I said,
you're stepping down.
I said, Tony, you know, you seem to know a lot. And Mark, you know it all. So why don't you just be on the board? And, it was just kind of funny.
Well, and then I got a lot of pushback at first. It's like, okay, guys, everyone agreed we're heading down the wrong path here. The dues went up by X amount and you're raising dues by X minus Y. It needs to be at least X, and there's two ways to balance the budget. You can either cut costs or raise revenues, or in this case, dues, or a combination of both. This is not that hard. So that's what we're doing. We're cutting costs, and unfortunately, we got to raise dues. All right, let's see. Is Brian Atwood on here? We're going to try to have some conversations on financing, and this might be a little in depth, but I think it was Leanne said they were trying to get a condo done on the ones in North Loop, River Station, and they were having an issue with Fannie and Freddie maximum deductibles. The insurance has just been a nightmare. So our dues went from approximately $70,000 a year to $170,000. That was a 1-year jump. And
For
yes,
your insurance costs?
yeah, it was going to be like way more. We shopped around and we're lucky to get $170,000.
Yeah.
But we were declared a hail state. We had a hail claim. That probably didn't help. And like you said, basically what happened is when American Family, our old insurance provider, underwrote everything, they weren't good at underwriting, and they spent way more money than they took in, which is why they got out of the business. You see that in medical too. When Obamacare started, Preferred One spent $1.31 for every dollar they took in, and quickly no longer offered plans on the MNsure. So that's kind of how insurance works. I don't know if is Brian on here?
Yeah, I'm here.
There he is.
Hi, Brian.
Maybe I stumped you with that one, but do you want to chime in with what kind of you look for on the lending side when you're evaluating associations?
Yeah, the key here, like anytime I'm talking with a buyer or a realtor partner, the key to making sure that your association purchase is going to go well is just preparation, making sure you're getting all these docs ahead of time. The first thing I always look for is to make sure that the property is not in an association, and then everything goes great. Besides that, it's terrible.
Hold on, I'm writing this down.
Yeah, right. Just don't do it. No, everyone thought it was a new rule that came out, and it's not. Fannie and Freddie have had this 5% maximum deductible, and it's 5% or the greater of 5% or $10,000. That is the minimum, I should say, maximum deductible you can have on your insurance policy. The reason that this seems like it's a new thing is because of the reasons that Dean and Rick are talking about, that, hey, insurance companies are abandoning associations. It's way too much risk. There's been so many claims, it's getting more expensive. And then the boards are looking at, do we take a huge increase to be able to afford this insurance, or let's just raise our deductible? So they're all jumping up to these 10% deductibles, but you can't do that. You can't get conventional financing if you have a 10% deductible, anything more than the 5% limit. So this is just a great note, going back to if you are talking to clients or you're on a board or anything else, to make sure that you understand the implications of any of these potential changes that you make, because we see left and right that we let's raise deductibles, let's not renew our FHA certs, and next thing you know, you have an entire project that now can only sell with cash or non-QM loans. Good luck. That's gonna be really hard.
So basically what you need to do is restructure your insurance policy in that case.
You do. Some will allow you, Fannie and Freddie allow for you to supplement if you had to take this one, but then you can get a backup supplement insurance policy, but it's not very common to see. The best solution is that you just need to call around and restructure and get back within that conforming limit.
So that's the other issue we were having, is when we jumped up from 70,000 to 170,000 premiums.
Mm-hmm.
And that doesn't even include the insurance for the board. That was just the hazard part of it. So our premiums were more like 190. We don't have 190 in our budget just sitting around, and it's not like when you take out a car loan, you can pay monthly. So we had to reach out to a third party organization to finance this. And it's the same company that did my brother's. Well, they charged us 13.14% interest. which pissed off a lot of residents when the management company didn't even share that. He signed it without approval from the board. Anyways, so that's one of the things I did is AA found out if you can actually take a loan out as an association, you're only allowed to take loans out for a very small number of things, of which hazard insurance is one of them. Or insurance is one of them. And yeah, we were able to find a local bank that would lend to us at 7%. So we saved some money there. We also learned that our reserves are being held at Wells Fargo and the money at a money market account. And that money market at Wells Fargo is paying 0.02%, not 2%, 0.02%, which rounds off to zero. And we were able to get 3.75 currently at our local bank, which is Bridgewater Bank. So that saved us over, and then that with the fees probably saved us about $14,000. That's one of the ways we save money.
Yeah.
So. All right. Oh, FHA financing, Brian.
Yep.
I had never heard of this. Yesterday, Nathan, or earlier this week, Nathan talked about spot approval. So we are not approved for FHA financing. We've been telling people you can't come in with FHA financing. The board made the decision that it's more paperwork, more costly for us to do, but also FHA allows people to come in with lower credit, and there's a perception that you get a buyer that's less apt to pay their association dues, let's just say.
Sure.
Your thoughts, Brian?
Yeah, it's a great solution. It's much faster, and there's typically no charge unless you have a third-party company, a management company, or someone else that is trying to do the spot approval. So spot is single unit approval. So if you have a project that is not wholly FHA approved, then you can get an individual unit approved for this one transaction, for this one loan, just so that person coming in with FHA financing can still purchase in that project. Now, it's not, there's also a misconception though that people say like, oh, the project wasn't approved for FHA. We tried to do a full project and it didn't work, so now we'll try a spot. That doesn't work. You're still asking for a lot of the same things, making sure that you're within owner occupancy limits, that there's not too many FHA loans already on the project, that it has adequate insurance. So there's a lot of the same requirements and same documentation to prove those things, but it can be cheaper and faster to just say like, hey, we can let this one-off situation go as long as the association can provide what they need. So it's a similar submission, it's a shorter questionnaire than is needed for the application.
So have you used this strategy to get into buildings that wouldn't otherwise accept FHA?
Very rarely. It really just doesn't come up that often. But it's a solution. I know in certain other states it's more common where they just won't do it. I mean, to me, my personal opinion is, especially when I was working on the management side, it's like, why limit your buyer pool, right? Whether you think it's a stellar purchaser or not, having more potential buyers helps improve the pool and the demand. So, a lot of times the people, they need to sell and they're not getting bites. Why cut out a huge segment? And especially today with rates where they're at, there's a lot of people looking at FHA over conventional for a lot of reasons.
What are those? Because my perception is you can get FHA 3.5% down, or you can go conventional 3% down. So other than lower credit, what is the advantage?
So one, everyone can get 3.5% down on FHA. You can only do 3% conventional if you're a first-time buyer or you income qualify. So if it's not your first home, or you're making you're making over the limit, then you don't qualify. So it does lower that potential down payment. And then also, I have a great example right now. I was sharing on another call that strong borrowers, strong income, okay credit, still within the realm of conventional approval. But when you're below a 700 FICO, conventional mortgage insurance is terrible. Like, it's really expensive, where you'll see some people, $200-300 a month in mortgage insurance, whereas FHA is flat. So in this one scenario, and the last piece of that is lower rates. Government loans are pretty much unanimously going to be lower interest rates than conventional will be. So in this one scenario, buyer purchasing a $400,000 house, they're doing minimum down. They were saving close to $500 a month going FHA over conventional. And we could go conventional, but goodness, $500 a month.
All right, Leanne, you're up.
Question for Brian. Okay, so how would I know as a listing agent if the townhome I'm selling or the condo I'm selling would qualify for a spot approval? If the association had just never applied for FHA eligibility. That might be a case. If they had been denied for some reason, obviously that's not.
Correct.
How would I know, and when would I be able to advertise that FHA might be an option?
Yeah, I can send out, there's a spot that you can search online. So through the HUD site to see if a condo project has been approved, and it'll also show prior applications. Maybe it just expired, or maybe it was denied, and that's going to speak to whether we can or not. So I can provide this information if you want to search. Otherwise, you can also just ask me, and I can look and see what the history is. And that's like, hey, it looks like they've never applied, or it's just been expired for several years. Here's the information to, do a spot. If we can gather these documents, then great, we can get it submitted. Spots can be quick too. They can take less than a week, whereas a full approval can take upwards of a month, depending on what that actual project is. So
okay, so I've used that web. Yeah, I definitely use
site.
that. So that'd be the best indicator. That's pretty thorough for even applications. That's great to know. And as a buyer agent, that's really good information for us too. If we have an FHA buyer and we're avoiding ones that they know FHA, that we can do some research on that, it sounds like, with our lender.
Yeah, it's really easy to do. And just going through making sure you know the project name, and sometimes just search the areas, because names can be really specific. So maybe just, if it's not too big of a town, search for every association, try and find the right one, the right address. But you'll see there that, hey, we're good to go, full project approval, or it was approved and it's expired, or straight up rejected. And like, well, rejected's a concern. All right. And not like you can't do spot, but sometimes it's rejected because they didn't turn in all the documents. So they rejected it. Whereas, well, okay, if we can get the right documents, let's send it in. But the other parts too are FHA concentration. There's limits on, it's 10% FHA units within a project. They don't want to have more than that.
Super info. Thank you.
All right, I think we're at the 1 hour mark.
Did you learn anything, Dean?
Yes, a lot actually. And that's the thing, the more I learn about associations, the more I realize I don't know, because it's so complicated. Oh yeah, go ahead, Lori.
Two things I wanted to mention, and actually, Leanne, I think I can answer your question. If you look at that receipt for the CIC, where the person signs that receives it, it says name of recipient receiving docs. They sign it and they date it. That would be your start date, because it's whoever signs that document is saying that they've received these documents. So that's why it's really important to use that waiver, or not the waiver, the receipt. The second thing I wanted to mention too is if you're listing any property that has an association, whether it's a CIC or not, is make sure that your sellers are up to date on their dues, because HOAs and other associations can stop closings if the dues are unpaid. So just remember that.
Very good.
All right, I think that concludes it. We could probably go on another hour, but people got stuff to do. It's that pesky day job.
Thank you so much. This was fantastic. We learned so much. I always just love, we amplified it. We asked a lot of great questions. We covered a lot of things. If this is something we want to cover again and keep on going, I think we obviously have a lot of good content here to continue on this path. So thank you so much, you guys, for presenting and teaching us so much today. We all learned a ton. And if you guys have any questions or need anything, reach out. I just cannot thank you enough for your time and expertise today. Dean and Rick, you are awesome. Tune in next week for Agent 21.
You can't see it, so I'm going to point it out. But behind us, move to the side, we got the Atwood mortgage stuff up there. We got the Century 21. We were really trying to kiss some butt for Brian, but it's so small you can't see it. So epic fail.
No, I love it. I love it. You guys did so good. That is amazing. We'll get you some larger stuff.
Yeah,
we can get that worked out.
All right. Well, thank you.
Should have had on your C21 Atwood hoodies.
Yeah, there you go. We do have those.
Yeah. E for effort.
Yeah.
Oh, thank you, everyone. Have a good day. Bye-bye.
Adios.